Afternoon, everyone. For all of you that have arrived early, actually on time, we're going to go over emotion control in FX. Can those of you that are here, please let me know if you can hear my voice and also see the screen in front of you clearly. All right, let's kick it off. So today we're going to discuss emotion control in FX. The agenda is to give you a quick introduction on who we are, and then I will discuss the brain chemistry behind trading FX, and then go over recommended risk management and emotion control techniques, and then we will discuss some general currency trading dangers, and at the end with a Q&A. The disclaimer is very important that you go over it, and also the risk warning, and then we'll proceed. All right. There was no sound because I wasn't talking. All right, let's proceed. So we are Blue Sky Forex. We're part of Blue Sky Binary, an education, research, and trading group. We're a group of around 12 senior traders around the world that teaches a range of strategies, both in FX and options. And we're presenting this webinar on behalf of Hot Forex in order to educate you to help you become highly profitable currency traders. Now, as you know, for those of you that have been attending these webinars over the last probably 2 years now, there are two types of strategies in trading. One is price action and the other is mean reversion, right? Of course, there's different types of methods on how you trade these markets, but those are the two kind of overarching market conditions that you will face. Now, navigating both market types requires great emotion control. That is probably 80% of the equation. And it's also probably why 90% of traders lose money in the long run, because they can't control their emotions. They can't manage themselves when they face a string of losses. So that's what we're going to discuss today. So what you have here is a 14-stage emotional cycle, right? It's classic cycle in investing and trading. It doesn't have to be FX. It can be almost any asset class that you're trading. But if you take a look at this, you'll see that generally speaking, traders and investors go through 14 stages of investing. Okay? And these are all emotional states. It starts with optimism and it ends with optimism, but it goes through the entire gamut of emotions that we experience when we trade, when we have open positions that are in the money, and when we lose, or when we're about to lose, if we have open positions that are out of the money. And typically, the stages are excitement, thrill, euphoria. And this is the most dangerous time when everyone is bullish on a particular subject. For example, right now everyone's very hot about the Snapchat IPO, and already if you look at some smart money investors, they're saying that it's overvalued. So when you get euphoria, that's traditionally the point of maximum financial risk. And when the positions start to go out of the money or there's a sudden turn in the market, anxiety, denial, fear set in, and sometimes panic. Panic selling, which is what we saw in 2008, for those of you that were around trading back then. So after that happens, you actually get everyone is fearful of the markets or of trading, and that's actually the point of maximum financial opportunity. And that then eventually cycles back to hope, relief, optimism. So this cycle starts at optimism and ends with optimism. Now, a certain amount of optimism is very important when you're trading and specifically when you're thinking about entering a trade. Otherwise, you'll never actually have the courage to enter a trade, right? So that's why it's so important that you trade with money that you can afford to lose. Okay. And it's also very important that you understand how the brain processes your trading. Okay, because there is real world physical impacts of trading. And I'm going to go over these next so you understand that trading is not only an online activity, it's a very real world physical activity. You have three parts in your brain. You have the neocortex, you have the middle brain, which is known as the limbic system, and then you have the brain stem, which is the reptile brain, right? All of us have it. And the third bit, which is the reptile brain, it's the bit that regulates autonomous functions like breathing, hunger, sleep, appetite, all of that stuff. The further north you go, that's where the intelligence starts to kick in. The middle brain, the limbic system, that regulates simple emotions such as anger, revenge, hatred, all these types of things, exuberance, excitement, comes from there. The upper bit is where you have the neocortex. That's where your brain is processing your trading strategy, right? That's the bit where you say, okay, I'm going to go long if this happens, I'm going to go short if this happens. Basically, thoughts, meanings, logic, associations are processed there. Now, if you didn't have the second and third part, you would actually be an ideal trading machine because you wouldn't get impacted by potential wins or outright wins or potential losses and outright losses. The reality is that you do have the second bit. You have the limbic system in place. And what happens is that this system is releasing hormones. And these hormones mess with your trading. They mess with your mind. So let's talk about the chemistry of winning. During trading wins, the brain is flooded with adrenaline and dopamine. All right? It gives you an emotional high and subsequently heightened levels of self-confidence. Winning is addictive. The more you win, the more you want to win. And that's true with any aspect of life, not only trading, right? But there is a fine line between confidence, which results in better trading. You need a certain degree of confidence to actually get a bit of ROI, right? In order to enter the trades, make some winning trades. And overconfidence, which actually results in reckless decisions and over trading, right? And for those of you that have had some really good days, you'll know exactly what I'm talking about in terms of you having a lot of good wins and then you get overconfident and you just blow it. So there is a real inflection point after which point confidence is actually negative to your ROI. And although this is dangerous during wins, what's even more dangerous is the hormones, specifically cortisol, which is a stress hormone that your body releases, that your brain actually asks your adrenal glands to release. And this is a very dangerous hormone. And this is something that should be kept away from trading as much as possible. Now, the problem is when you lose, the way we are wired is that we associate money with survival. So when you lose in trading and when you have successive losses, rationally, you don't for one moment think, oh God, this is the end of my survival. I won't have food on my table. But actually, your body has over the years gotten so used to associating earning money with surviving that this is actually an internal response to a threat of your existence. Believe it or not, every time you lose or you lose a lot of money in trading, your body treats it as a fight or flight response. The same response you would have if you are walking in the street and someone comes up to you with a gun, or if you are in a big forest and a tiger suddenly comes in front of you, right? So this fight or flight response results in cortisol being released. And in itself, cortisol is important because it manages stress, But it's very dangerous because cortisol actually causes something that is known as an amygdala hijack. The middle brain, your limbic system, actually dulls the synapses, the synaptic responses between the middle brain and the neocortex, such that your neocortex is no longer capable of actually processing your strategy. What that what I'm basically telling you in English is that when you're trading, you're not going to be able to work out your strategy, navigate the market safely after you've had a lot of losses. Because most probably your amygdala has taken over and you are just trading to win back your gains. You're trading over aggressively, and that's a very dangerous situation to be in. Okay? So, this is important to note that when you're trading, your body's releasing different types of neurotransmitters and hormones. And generally speaking, because you have this emotional makeup, otherwise you won't be human, you are generally a chemical mess when you're trading. That's not a bad thing. It's important to have these fight and flight checks and balances in place, but in trading specifically, it can actually impede your trading. And this is why everyone wants to develop the best expert advisor, right? But very few are very successful at doing that. So, for us mere mortals, what do we do, right? So, we can't get a lobotomy. You can't get rid of the amygdala in your brain, right? So, what do? You stick to four things: money management, a milestone based business plan, virtual money trading, and community reporting. I would actually say that these last three are more important than the first one. The first one is very overhyped these days. Everyone has a money management plan. So I'm not going to go over in too much depth about this, but for those of you that have been on these webinars, you'll see that the Kelly Risk Management System, which is your win rate and your profit factor, it gives you a percentage that you should allocate to each trade. Never go over that percentage. You can go under that percentage, but never go over it. And if it spews out a ridiculous figure like 15% or anything more than 5%, err on the side of caution and stick to 1 or 2%. The Kelly risk management system is tried and tested. It's not the only risk management system, but it's a good one because it's dynamic, it's adaptive, it adapts to your trading performance. Okay. So again, I'm not going to spend much time on it. You can Google it. It's very easy, the equation. Just plug in your historical win rate and your profit factor, and you'll have the percentage. Okay? So use that as a good gauge. And if you experience a loss of more than 5% of your capital, force yourself to log out. Right? That's really important because normally you're not going to recover on any given day from a 5% drawdown. If you have a small account like $100, $200, it's a different story. But if you're trading with size, it's very unlikely that after you've had a bad trading day, you're going to recover that day. So you might as well log out early and come back the next day. The second and more important thing I would recommend is a milestone-based business plan. This is actually very, very crucial. It can be Excel-based. Okay, it can be a simple Excel plan or Microsoft Word or whatever software suite you want to use, but it should track your daily performance, number of trades, win rate, risk reward ratio on the trades, and a bit of notes for each trade entry, trade exit. And you build this over time and you'll notice that it really, really helps install discipline. Okay. What's very important is that factor in regular withdrawals, right? And that's very important because this way you can reward yourself and you can actually also see, okay, it's working. I'm actually making money. Do not deposit 5,000 and expect to grow that to 1 million in 5 years and then withdraw. That's not going to happen. These are unrealistic, detached from reality targets. Final thing is factor in cool-off periods. Okay, factor in cool-off periods. So basically what I mean is factor in a holiday, factor in a few days off, 10, 20 days off after every 1 or 2, 3 months. Get away completely from trading, completely. And you'll notice that it will improve your performance. Linked with this business plan, Let's skip virtual trading, go to community reporting. Try and trade with another community, with a set of traders. You will do naturally better. Okay. There is a risk of herd mentality where all of you enter the wrong position, but we're not saying you should discuss or confirm trade positions necessarily, but share your performance at the very least with others, right? And this, coupled with your diary, will help you trade safer. The last bit is virtual money trading. So, there's two camps of people here. The first camp says, "Oh, well, virtual money isn't. What's the point? Because ultimately, it's not really simulating my real reactions, right? My chemical reactions to wins and losses. So, why should I trade?" We agree. A virtual money account is limited because people will make millions on their virtual money account, but then when they switch to live, they'll start to lose money and they'll wonder what's going on. And the main reason is what we described earlier. It's the chemicals. You can lose $1 million in a virtual account. It's not going to impact you at all, right? Unless you're crazy. So there isn't really anything happening there. If you lose $1,000 on a real account, you'll feel the pinch. So to that degree, the naysayers of the virtual money trading camp are spot on. But on the other hand, a lot of you like to try out new strategies, right? There's no point in trying it out on real money, because if it doesn't work on virtual money, how is it ever going to work on real money? So always tweak existing strategies and try out new strategies on a V-Money account. All right. So let's discuss some currency trading dangers. Now, the human body, the human mind, is not evolved for trading, right? It wasn't in our plan for evolution, so to put it. And so this is why we have these adverse reactions. This is why 95% of people can't trade. It's not because they don't know when to go long and short. Indicators can be very powerful. Trade patterns, technical patterns can be very powerful, but where things go wrong is on the money management, emotion control side. And that's because of the chemical chemical makeup that we described here. Now, very few people know this. Very few people have actually drawn links to this. There's 1 or 2 studies on this. But this is, what brokers won't tell you. Or at least, let's say, it's not something that's publicized, right? But at Hot Forex, we're obviously telling you this information because it's important you know that. And it's important that you know your weaknesses. So the answer is, okay, you have the ability to do these 4 steps, or create a robot that trades for you. Both is possible. The latter is very difficult. Okay? This is more doable. This is more in your hands, these 4 steps. If you are going to go down the EA route, the expert advisor route, social trading or PAM route, make sure that there is a 9 to 10-year history of performance, so that you are not caught unaware when the robot comes undone with some news or some asymmetric market event, right? And the FX market has a lot of asymmetric market events, like you saw with the Swiss National Bank 2 years ago, like you saw with Brexit last year, and like you see now weekly with Donald Trump. So be careful with those events. They can cause a lot of drawdown, and these expert advisors are not so well geared to navigate those. The second point, I'm not going to reiterate, I've already said again, 5% of traders make money long run. Now that's thousands of traders every month make money, but it's not like 30-40% of traders are making money. Okay, you can come into that 5%, but you need to learn the technicals, and you need to be in control of your emotions. Okay, so on that note, I will now take questions.
Thank you very much.
Yes. Okay, so a question from Isaac. Isaac is asking, would you please summarize again what happens in the mind? Sure.
Free to call
Isaac, this is the bit the number one here is the bit that is the rational bit. This is the bit that where you've devised your trading strategy. This is the bit what controlled when you first enter the currency markets every day. You have no cortisol or anything in your body that's being released. Very, very small quantities, nothing of note. This bit is firmly in charge. When you win, um, adrenaline and dopamine is released. It makes you feel confident. You feel great that you won money. And that's okay. That's actually not a problem. But if you win too much, right? If you have too much, that's where it becomes dangerous. That becomes pretty dangerous because then you become overconfident, and this bit here starts to take over the middle brain, and you start to make reckless trading decisions, over trading. The worst that can happen then is that if you lose suddenly, you go into revenge trading mode where you don't want to accept the fact that you were winning first, now you're suddenly in losses, and this bit here completely takes over the top bit. Okay. And it does that after it's released a chemical called cortisol. Okay, the cortisol is a stress management response by the body. Okay, Christian Roga is um, asking, it's a pretty low percentage, 5%. Are we taking into account only professional traders or also beginners? That's a good question, Christian. So this is the entire retail market, which is around 4 million traders around the world. And it's around 400 billion in daily turnover, right? That's the retail market. So if you try and kind of bifurcate that further, what you will see is that in that retail market, there is a subset of people, around 5, maximum 10%, that are making good money. 1 or 2% are making obstinate amounts of money, ridiculously high amounts of money. And they've figured out the FX market. And then you have obviously 90% of the market which just has no clue. Okay. Any other questions? So question from Joel Barth. How do you usually start your trading? The most important thing, Joel, is stick to a routine. Don't trade outside that routine. Right? There is no, in terms of what time. of day. For example, I prefer sort of evening trading. Um, a lot of the news has passed if I'm doing day trading, and if it's kind of weekly positions, then it doesn't matter. Then I use the news. But the key thing is to know what you're good at, and then just focus on that and become an expert at that. There are no rituals, pre-trade rituals like meditation or yoga. Although I do that, that's very recommended. Very, very good for the mind, meditation. But there's no specific sort of thing. Isaac is asking, what differentiates FX and commodities trading different from gambling? Well, gambling, Isaac, is just betting. I mean, it's 50% odds, right? The outcome is not influenced by previous outcomes. If you have an equally weighted coin, it's going to be 50 tails, 50 heads, right, over time. So outcome with the markets, there is such thing as oversold, overbought. There is such thing as fundamentals driven trends that you can capitalize on. It's all about bottom up research, either technical or fundamental. So yeah, the more you know about the markets, the better you will trade them. Yes, so Jai Prakash is asking a very important question: how to avoid revenge trading and day trading. Usually I will be trading 0.05 lot size when I see $50 loss. I thought of entering one standard lot to recover the loss, but I lose more. Yeah, that's known as martingaling. And you lose more because the markets will stay trending, and so it'll also wipe out your standard position, your mini lot, micro lot, standard lot position. It'll just wipe it out. Never ever martingale. The moment you find yourself needing to do that, you've already lost. So accept the loss, because if you were in a 0.05 lot size loss, that's smaller than the martingale loss, right? So just see it that way. Any other questions from anyone? See a question from Sajadur Kansun. Is hedging a safe way to trade? Yes, it is. Mojelfa is asking, can we have updates on future webinars? You can contact webinars at hotforex.com and they will give you our webinar schedule. Final call for questions.
because it's I know because that's what I did, but it's not as like when it comes to the preview. This is how because this is how it's the preview, not like it's going to be printed out. Yes. No, they don't send it. It's in my account. Like I just put see preview. And I didn't send anything. This is just. We didn't do anything. No, we didn't buy it. This is just on our account. Fix it first. I don't know if this is gonna work.
Kotso is asking, is there a way to influence the FX markets? Kotso, there is, but you don't have the ability to do that. So retail traders don't. Retail actually only accounts for 6 to 10% of the whole market, right? So the rest of the kind of 3.5 trillion, 4 trillion is what really moves the markets are the big investment banks, institutions, countries. So retail traders, unfortunately, no. Joel, if you start and you end up with losses, then you stop for the day. And you have to learn why you lost. I mean, it's the most important thing before you move on the next day. You have to analyze the losses and then find out, okay, that's what I did wrong, and then apply that modified strategy on the next day, and you should see some improvement. And this is known as iterative strategy optimization, right? So it takes a few iterations as opposed to just kind of coming to the market and saying, I'm here, where's my money? Okay, last call for questions. Sure. Joel, you're asking which currency to trade. The best one is to stick to the majors at first. They are more impacted by news, but they have healthy liquidity. So you'll get low spread and enough volatility in them to actually, make the moves that you need to make the pips. So stick to the majors. All right. This is recorded, and we will send this to the webinars team at Forex, and then we take it from there. See you all next week. Bye-bye.